And a big welcome to our live audience for the Digital Health Investor Talk show. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me at x.com/Stephen Wardell. Our show today is What's Working in Digital Health? After an unprecedented wave of software innovation, where are digital health products creating clinical and financial value for buyers? Our guest today is Alex Lennox-Miller. Alex is a healthcare IT analyst at CB Insights, where he covers how emerging technologies are changing front desk and back office workflows in healthcare. You can follow him on LinkedIn. This show is being recorded and will be included in my podcast series called Digital Health Investor Talk. Subscribe to our podcast on Apple and Spotify and leave us a review. We always love getting new subscribers and a 5-star review. We have new podcast links for the shows, so make sure that you see recent episodes when you subscribe, or you could be subscribing to an old page with an old version of the podcast. This is not investment advice, and we are not investment advisors. Here's the format of today's show. It's 90 minutes long, and Alex and I will spend the first half discussing the news and the macro picture and other topics, and then we'll focus on our special topic of the day. And we'll be taking your questions throughout in the LinkedIn text chat. So Alex, please welcome to the show, and please introduce yourself.
Thank you, Stephen. Well, it's great to be here. My name is Alex Lennox-Miller. I am the lead analyst for healthcare at CB Insights. I have been working in healthcare for about 10 years now, working as an analyst for about 5 of those. Prior to that, I worked mainly with hospitals and healthcare systems, doing process improvement and process analysis. I've been really lucky to be able to be covering healthcare as an analyst at a time like this, where we've seen so much change and so much upheaval over the past few years. So I'm really excited to be here with you, really excited to talk about what we're seeing in the market now and where things are going.
Great, thank you. So the first category today we'll talk about is macro news. We continue to see the stock market reach record highs. That means that publicly traded companies are getting full rich valuation. Investors are enthusiastic. We don't see that reflected in digital health private company investments, and I'm starting to wonder why. This ought to be contagious. We ought to see digital health private market investments start to look like the NASDAQ. And I think we're starting to see the past 2 years of low levels of digital health investment, digital health valuations, is starting to be affected by this, and I think we're going to see more of it in the future. But so the NASDAQ is at 16,900 or so, and this is led by positive sentiment around tech and AI stocks in the NASDAQ. The market has kind of shrugged off concerns of persistent inflation. Inflation is not great. It continues to be a concern, but the market's shrugging that off. We're concerned that the Fed we'd like the Fed to cut rates, and we're concerned the Fed may be becoming cautious about rate cuts in the second half of the year. But the market is shrugging off those concerns as well. If you're watching the video version of this, you'll see just a story from CNBC reflecting that the market, that stocks are at record highs, and this has been shrugging off concerns about inflation being too high, concerns about the Fed perhaps being cautious on rate cuts as well. So, in general, having high public markets is a very good thing for the innovation economy for a number of reasons. First is that we usually expect private markets to follow public markets. So if public markets are high, then we would expect private markets to see higher valuations and more activity in private markets. Second is it's setting the ground well for an opening of the IPO window. The IPO window is currently closed, and that's a bad thing. We want young companies to be able to exit through growth, through IPO, through a trade sale. And if the IPO window is closed, it means that young companies can't exit, investors can't harvest a return, young company leaders can't sell their shares and go do new startups. So a high stock market is generally a good thing for the innovation economy. We'd like to see rate cuts as well, and the Fed has hinted there will be 3 rate cuts by the end of December, and that's what people are concerned about. Is that if inflation is persistent, we might not see those 3 rate cuts of about 25 basis points each, and rates are still too high for the innovation economy. So, Alex, any thoughts on market levels and the Fed and that sort of thing?
Yeah, I just want to, I'm going to disagree with you a little bit about what we're going to see with valuations in the digital health space. I think what we saw over the course of the tail end of 2020 and 2021 was such an enormous growth, an outsized growth in valuations, the amount of money that was being thrown around, the amount of money that was available to companies that really weren't ready for it and couldn't really justify that level of investment and the valuations that they were being given. And we're really only now at the point where those companies maybe are facing the need to raise again. And so I think what we're actually going to see is a series of either undeclared valuations or down rounds as companies that, you know, we're getting 100, 150, 200 million dollars at a, grossly inflated valuation 2 years ago, have to go back to their investors. Some of them have managed, to be floated over some periods of difficulty, but I would guess that the next year or two is going to see some real some really lowering numbers in valuations, purely for the fact that there were so many companies where the valuations skyrocketed and they just can't justify it.
So companies have done all the belt tightening they can, and they're running out of their runway of cash. And a lot the young innovative companies are still cash flow negative, and they're going to have to come back at significantly reduced valuations as compared to 2.5 years ago, for example.
Not even young companies. I think we've seen a number of companies that are going shockingly late stage with the number of rounds that they're getting. And if those companies aren't cash flow positive, if those companies can't justify to their investors in a much tighter investment market, we're going to see some cuts from companies that, have been pretty well established within the space.
Okay, thanks. And then the next story I'll point to, this is just, we continue to see Chairman Powell, the Federal Reserve, be concerned about inflation. He should be concerned about inflation. We really hope that raising interest rates to where they currently are the federal funds rate at about 5.5% or so, will address inflation. We hope that will be adequate to address inflation. So he's concerned about inflation and saying that rates will hold steady. We still hope he'll cut rates 3 times by the end of the year. But this is kind of the Fed backtracking a little on its optimism of several months ago. And Larry Summers has actually Larry Summers is a former Treasury Secretary, former president of Harvard. He's one of the only sort of leading economists out there to raise the idea that that inflation is so concerning, the Fed may have to raise rates further instead of cutting rates. So that's the debate. But in general, what we're seeing is the stock market is ignoring these concerns and continues to rise. And that's generally a good signal for private markets that have been frozen for 2 years may get a little better following public markets. And then once again, reflecting on that, private investment, venture investment, Series ABC investment has been very frozen for 2 years. An interesting story from Fierce Healthcare, where they attended the American Telemedicine Association's Nexus conference, spoke to a bunch of investors who are cautiously optimistic about the state of the fundraising market. And that's a better outlook than a year ago. A year ago, people were very pessimistic about the state of the fundraising market, but we're seeing in the trades, people are talking now about a little more optimistically about the fundraising environment over the next 6 to 12 months. So for Alex, just any thoughts about the biggest question I get asked from my audience is, when is the private market fundraising environment going to get better? And these are some positive signs that we're seeing in the marketplace. And for our audience, any questions that you guys have about macro issues for us? But Alex, any thoughts?
Yeah, so when we looked at the funding for the first quarter of 2024 in our State of Digital Health report, what we saw was actually an uptick. Not over the long term, a huge amount of money, but more than $1 billion of growth within digital health investment, a significant percentage, still massively down compared to where we were even in 2019. Not even considering, comparing it to 2021. But it is possible that this is, starting to grow, that we're starting to see a return to some willingness to spend and some willingness to gamble a little bit. We saw a massive shift in the amount of money going to mid and late stage companies, grew phenomenally. Much less money going to early stage companies in the first quarter of 24. So, and, at the same time, deal sizes rose across the board. So I think we're seeing investors get a little bit more confident, more willing to trust that companies that they have faith in are, going to use the money responsibly, do good things with it, make some good choices, and give money to those companies that are earning it.
Great, thanks. So now moving on to the second part of our second category, which is industry reports. So here we look at reports that came out over the last couple of weeks and any particular findings. And so for our audience, you're welcome to mention a report you've seen that you think is significant, that you want to call attention to the audience. And so I didn't see any reports of that I usually follow coming out this past week. But Alex, you guys write reports. And so last couple of weeks, any reports you want to mention and then some key findings from them?
Yeah, I think the most interesting reports that I've written recently have been on big tech. When we look at Google, Microsoft, Amazon, there are some really interesting things happening there in terms of how they are innovating within even relatively stagnant spaces like cloud hosting, which has been, hasn't seen a lot of really exciting tech development recently. We are aggregating if you are a client, you can get those on demand on our platform right now. We are aggregating them into a larger big tech and healthcare report, which will be coming out in a week or two. And I think there's some interesting stuff there. The other thing, the other report I saw, which was really interesting, and, maybe I shouldn't say the name because, they're technically a competitor, but KLAS put out a really interesting report on acute care EHR volumes. And that was fascinating. Seeing the changes in EHR adoption, which companies are growing their share, which companies are lowering, seeing Oracle really drop, Oracle Cerner really drop, Epic take just a lot of clients. It's not a good sign for Oracle. I don't think anybody was under any impressions that, Cerner was doing, phenomenally well competitively, but they certainly were keeping pace with Epic. And to see them, dropping so precipitously was really surprising. It really makes you wonder to what extent the amount of focus, the amount of energy that the VA DoD projects that Cerner is involved in are taking from their hospital clients. Are there, a lot of people feeling sort of undercared for and underloved within the Cerner ecosystem right now. That was probably the most, both the most surprising and the most interesting report that I've read recently.
Great, thank you. Yeah, and do you have a sense from the perspective of, say, 5 years, why Oracle is doing so much worse? Oracle Cerner is doing so much worse than Epic. I know Epic made a big effort to win over the pickiest academic medical center customers and succeeded. That doesn't necessarily mean it will sell to all hospitals better than Cerner would. So any thought as to why it's playing out this way?
I think Epic had a realization a few years ago that the way they'd been doing things for a long time was really doing both themselves and their customers a disservice. They spent a lot of time and a lot of effort trying to standardize their deployments more, standardize their back end more, standardize their data formatting. And what that allowed them to do was tie in a number of, smaller hospitals into their, and even the AMCs, the academic medical centers, into a larger data network. And that has been really useful, I think, to a lot of people within the Epic ecosystem. It has allowed some benchmarking that was never possible before, research tools, being able to do population health analytics and other analytics across, the breadth of Epic's customer base rather than just within your own set of medical records. And I think that's been, combined with the fact that makes it easier to do upgrades. It's made the upgrade schedule a lot faster. It's made it easier to deploy new tools. So Epic has been, really able to run on the front edge of a lot of the Gen AI stuff that is coming up. But, it's also, I think, a recognition that despite paying, $28 billion, Oracle bit off maybe more than it knew it had with Cerner. Made some really quick moves to integrate Cerner into the Oracle Cloud, to integrate Oracle products. And for a product which had previously been really touting itself as extremely modular, extremely flexible, able to, really take on and use any third-party application, to suddenly move towards a much more rigid set of partnerships and deployment possibilities, I think, was kind of a surprise. There's a good comment in the chat. It looked good on paper, but merging and integrating companies is really hard. Trying to do it really quickly is difficult at the best of times. And I think you combine that with the sheer size and scope of what Cerner has been doing with the DoD, and there's maybe too much for any one company to handle.
That's good. Thank you. Okay, great. So we covered a couple reports that came out, and now moving on to trade journal news. So I think it was a relatively slow week in the world of healthcare services and digital health. I can't really think of any story that really stood out. Perhaps there's a category story, which is hacks of hospitals that continue. So there's more hacks. There's a story here about Ascension's ransomware hack. This is just awful ransomware hacks where somebody is hacking hospitals and perhaps scrambling their data and then offering them the key to unscramble their data or something back in return for payment, sometimes in cryptocurrency. It sounds like something from out of a Michael Crichton novel. Alex, any thoughts from you on kind of the story of the week or the last couple of weeks?
Yeah, I mean, this has been sort of a slowly growing problem for a number of years. We've been seeing, fears about cybersecurity and health data security for a long time, and now it's kind of broken into the public eye because of the scope of what's happened. To me, the scariest thing about it is how much it's complicating the provision of healthcare. having Change Healthcare go down for as long as it did was a real, terrible blow for, providers across the country. They are, still struggling to recover from it. Ascension, going down had them redirecting patients to other hospitals, closing their ERs because they simply couldn't function. That's almost scarier to me than the financial implications. Although, we are seeing some concern now about who is actually going to hold responsibility for some of these things when it comes to a hack like Change Healthcare, that's of a data exchange rather than of a provider, but not entirely clear at the moment who holds the responsibility for all of those HIPAA violations and who's responsible for notifying patients and everything else that the law mandates. So, yeah, absolutely staggering. And, really, I think we've said it a number of times over the years, but a wake-up call to the industry that this is something you need to prepare for. All of that disaster planning, all of that worst-case scenario brainstorming that you've been doing about hurricanes and earthquakes and whatever else, you got to include this too. Your EHR could go down, and you may not have any idea when you're going to get it back. And you better have something in place that's going to let you continue providing care.
And I'll just add that, of course, we had the High Tech Act and Meaningful Use beginning in 2009, and so it's been 15 years since then. And what's happened over that time is that in order to provide care, we have to take all the data and put it into the EMR. And then to provide care, we have to get that data back out of the EMR. So we've made EMRs critical, intentionally made them critical to the care delivery process. And then what happens when you don't have your EMR anymore? When key data that you use to make decisions is not available? It's terrible. And there was a story from over 5 years ago about a hospital in California that got hacked by hackers who demanded money. And they had to continue to provide care every hour, every day while their data was scrambled. And they went and found all their old forms and got out their old forms that had people filling out paper forms and walking around handing them to other people. So they revived paper forms and they revived the sneaker net to keep the hospital going. But their forms were inadequate and the care was inadequate. And that was 5 years ago. It's only become, data has only become more critical to hospitals and care delivery since. Also, I would say, in my opinion, that hospitals spend less on IT security than other major enterprises. So if you have a $5 billion retail store chain and a $5 billion a year revenue hospital chain, the retail store chain is going to spend more on IT security than the hospital system in general. So we've got all of our personal, private, confidential, protected health information, and it's being stored by enterprises that spend less as a percent of revenue on IT security than a retail store or a business. And you may see that, and when that money is spent by hospitals on IT security, it goes to national IT security firms. It doesn't go to digital health companies. And so if these scandals and these crises have are a punch in the nose to hospitals, cause them to change at the board level, cause them to order more spending, it's going to mean taking IT dollars and other dollars that might have gone to digital health companies, to software vendors that are specialized in healthcare and that sell clinical and financial solutions to hospitals. And it's going to put it into the IT security category, which then goes to national IT security vendors who are not healthcare vendors. And so it takes it out of these crises create a reason for boards to have different spending priorities and take money out of the digital health economy and put it into the national IT security vendor economy, which is bad news for our friends. So any other thoughts on that, Alex?
I mean, at a certain point, there's only so much security you can have. Change Healthcare is owned by, the biggest healthcare company in the U.S., if not the world. UHG is massive. I can't even imagine what their digital security spend looks like. But it didn't help. They still got hacked. They still went down. They still didn't have recovery solutions in place. I think you're right about, first of all, the ratio of spend on cybersecurity, the understanding of the risks and the threats. But I also think that there needs to be a recognition within healthcare that you have to have planning in place. You have to have some kind of backup. If your next step from your system being hacked is to go down to the basement and start digging out mimeographed forms, that's not enough. There really has to be more preparation and more done to prepare on every level for not if this happens, but when.
That's great. So moving on to some other stories from the trades. So first of all, there were not a lot of fundraising announcements this week. That's more bad news. We like to see fundraising announcements. This is still a time where there's more wind downs than fundraisers, still a time of down rounds. I'm calling it a fundraising environment spring right now. Things are getting a little better, and in some pockets, things might get much better. But we're still in tough times for most of us in the innovation economy. So I was intrigued by an announcement by Uber Health that it's announcing a new caregiver-focused offering where caregivers can order rides for themselves or deliveries for care receivers and have these paid for by the benefits of the care recipient. So really interesting stuff. I think that's brilliant. There's a lot of intriguing room here for innovation. One I've heard repeatedly of is, and this is not this article that we're talking about here, but it is that oftentimes you'll have someone who's getting a surgical procedure and they miss the appointment. So that means that the room was prepped, the time of valuable people set aside, the time of valuable spaces like operating rooms in hospitals was set aside. Then they missed it, and that was a $25 taxi ride. But they'd planned to drive. They had a complication. They had a problem. They didn't drive. And so getting rides to people for expensive procedures, that's always been an interesting logistics issue that has been addressed already by Uber and Lyft and others. And then the next one is actually, I haven't seen this well addressed, but it is putting kits in the back of cars that would allow you to take 10, 20, 30 clinical grade measurements at home and then sending a driver to take the kit. And maybe it's already in their trunk, so they don't have to go and pick it up somewhere and take it somewhere. They have a kit, costs $300 in their trunk, and then they get preferred medical business as a driver. And they also have passed a Cori check or whatever, so that they can go into someone's home and watch them take a blood pressure reading or some other, or do a ear exam where the video image goes to a provider. And so that's innovative. And then these new ones where a provider can have themselves driven or have a delivery made, and then the care recipient's benefits pay for it. Very interesting, exciting stuff. I like this kind of innovation. I hadn't heard of this new kind of product before. Alex, any thoughts on the Uber Health story?
Yeah, I mean the question of transportation, even to a non, super urgent, incredibly costly surgical procedure, just getting people to their appointments, to their regular checkups. The failure to do that costs hospitals and health systems hundreds of thousands, if not millions of dollars. Especially when you start taking into account the wasted time for a provider who is, can't fill that slot, or is waiting for a patient to show up who's never going to appear. The question of no-shows, the question of cancellations is one that's been dogging healthcare for years. I hope that solutions like this make a significant difference. I think the area where I think we can see the most potential benefit from stuff like this is as we start to see more momentum in the food as healthcare space, for example. the ability of providers to have easy, straightforward ways to get healthy food to some of their patients. The ability to not just give them a list or refer them out to somebody who might be able to help, but to really set it up and have it delivered on a cadence and ensure that they're getting it. That could make an enormous difference, especially to people, who have trouble with mobility, have trouble with access to transportation, live in a food desert, have other issues. I think this kind of service has a lot of possibility. I just hope that we're able to put the structures in place to support it and really take advantage of it, and not just have the product out there and not really have what's needed to have it be as much of a difference maker as it could be.
Yeah, thank you. And another story I thought was worth commenting on is that Hims and Hers. So these are one of the most prominent of a wave of direct-to-consumer providers and pharmacies that we saw out there. So with Hims and Hers, you interact with a provider associated with Hims and Hers, who then gives you a prescription, and then you then have the prescription filled, typically by mail order. And they provided a new way to reach consumers, very different way of reaching consumers than your typical visiting of a primary care physician. And they also tended to go after, interestingly, drug categories where patients might have had a doctor they liked, and they didn't want to talk about the category doctor.
Wow.
So they would go after these would go after I need to get checked for STDs, or I'm having troubles with erectile dysfunction, or I'm having male pattern baldness, or something like that. And so someone who has a doctor and might be covered would rather talk to a stranger on the internet, and then maybe pay full price, and maybe not get covered, or have it covered less conveniently, have to submit a receipt, by mail or something, to get it covered. So very interesting. In general, I like these kinds of companies because they figured out a way to get consumer change, which is consumer behavior change, which is very difficult. And they've also made drugs more accessible as well by being on the time frame and in the manner that and in a more decentralized location and situation and setting than your typical healthcare. So they have announced they're making available GLP-1 injections as part of a weight loss program, and that this will cost $200 a month. So that's very interesting. That just shows more and more. So first of all, GLP-1 is just amazing. Now, they're a molecular therapeutic, and the role that digital plays in them would be in things like adherence or to taking the drug, also adherence to lifestyle change surrounding taking the drug. That's where digital plays a role in this. But this is another company jumping on the bandwagon of GLP-1s, a massive hit category drug that seems to actually work. It's been so hard to get behavior change and weight loss, and these seem to actually work. So I thought that was, a lot of companies have added GLP-1 or GLP-1 adjacent programs, and here's one of the big ones you'd expect to do it is adding this, and it costs $200 a month. I'm not sure how that compares. I've heard higher prices in the past for GLP-1s, and so I hope that's it's making it more accessible and cheaper as well. There's also so much demand that there is a production lag in providing GLP-1s, and I hope that we can overcome that, and competition will bring that price down further, and it'll be more plentiful. I also hope there's no side effects, but and people are concerned about side effects with GLP-1s. There's also side effects to obesity as well, like diabetes and high blood pressure, and so we should weigh those considerations if you're thinking of taking one. So anyway, Alex, any thoughts on that news?
I agree with you on a large number of points, but honestly, the biggest concern I have when it comes to announcements like this, and it's true about Hims and Hers, Roe made a very similar announcement. I think Weight Watchers, announced a digital product that involved GLP-1s. These are not these are not intended to be obesity drugs. These are drugs for diabetics originally, and they're very effective and very needed by people who have those conditions, and they are struggling to get them now because of the shortages caused by this kind of prescribing. Um, I'm glad that there are new solutions for dealing with obesity. I hope that uh, this is not just going to make it even harder for people to get the drugs that they need. Um, I haven't looked into this specific announcement by Hims and Hers, but the other thing is, like you said, this is not just a solution that can be applied by taking an injection once a week. This has to come with behavior change. This has to come with some really serious recognition and adherence. And if they're not providing that, if this is just sending, injections, on a cadence, if the drug is even available, it's not everything that's needed. And it's not, I think, really going to impact the problem that you're discussing, which is a serious one and has, really serious implications for personal health, but also, for the healthcare system as a whole. I'd like to see more of these that had that recognition of everything that needs to be done and trying to provide the level of broad integrated care that's needed to really produce change here, not just how many doses of Wegovy can we, sell to new people this month.
Yeah. Well, thanks. And then the last trade journal story I saw that I wanted to call attention to was Transcarent. So this is the company everyone's watching, Glenn Tullman's newest vehicle. They unveiled an AI-enabled consumer platform for care navigation. They call it wayfinding. And this comes after they recently raised a giant round of funding, 126 million, led by General Catalyst and Seven Wire. So interesting to watch what Glenn Tullman is doing. And a lot of people have speculated on what he's doing, and everyone wants to know because he successfully led Allscripts, and then he later built up Livongo and sold it to Teladoc. So people want to see what he's doing. And what I think is going on here is that he's continuing to play in the employer health tech market, which is where he built Livongo, starting first and foremost with the diabetes care management app for employers to give their employees, also hypertension in that suite. And my guess is that that category to employers is very important because it's very large, the care management area. But my guess is that because of non-competes, he can't just go and do the same thing all over again in that field. And so he's gone to another category selling to employers, which is navigation. And navigation is very important to employers because it gives employers a strategic tool to steer overall spending, to steer employees toward high-value networks, to have employees use lower-cost benefits rather than high-cost on-demand healthcare services. And so I think basically he's looking to put together a number of different kinds of benefits for employers, but navigation is one of the strategically important ones for employers who want to try to bend the overall medical trend for their company down. So this story just means he continues to proceed to build this new company that's going to be strong in navigation and offer that value proposition to employers that we will get your employees using high value care and bend your medical trend down. So any reaction from you to that story?
I mean, I think you can't launch a digital health company without immediately becoming aware of three other problems facing healthcare that digital tools could potentially solve. So it doesn't surprise me that he keeps finding new ways to get involved. What's interesting about this one to me is how far beyond I think the conventional wisdom of patient navigation or even benefits navigation this goes, tying in elements of symptom checkers, asynchronous health, even telehealth and virtual care. Not going to be the first app we've seen trying to be sort of the central clearinghouse of healthcare activity. I think it's going to be interesting to see how a third-party tool like this competes with something like MyChart, which is sort of the default for a lot of these services, for a lot of healthcare providers. But going to employers, having it be part of the benefits package is pretty compelling. We've seen a lot of adoption. We've seen a lot of interest, both from employers and employees in this kind of solution. So, I think it's unquestionably a gap in the market, and it'll be interesting to see how it plays out.
Great, thanks. And do you have any trade journal stories you want to bring to our audience?
So I think the most interesting one to me, first of all, well, I guess there's two. First of all is an announcement Epic came out with just this week, offering an open source tool for validating AI algorithms. They launched it on GitHub. It is free. It's open source. You can use it on any healthcare AI algorithm, regardless of what EHR it's living on or who designed it. There's been some, I think, pretty optimistic statements about what this might reflect as far as Epic's strategy. Are they going to start releasing more open source tools, more EHR agnostic tools? I don't particularly see that happening. It seems unlikely. But this is still a very good thing. Transparency, trust are still major issues within AI adoption in healthcare, and rightfully so. The ability to test and validate algorithms with a third-party tool, with one from a vendor that maybe you trust, but you can look at the code, you can review it, you know exactly what it's looking at and how it's working. That's a great thing to have access to. The more of those that are out there, the better. I think for the most part, this reflects the fact that Epic understands probably as well as anyone that when tools go wrong or a tool does something that someone doesn't like, they aren't going to blame the vendor of the tool. They're going to blame the EHR that they're working in. And Epic has probably taken a lot of flack for things that it doesn't consider to be its fault. I think it also is, a part of a larger strategy to have a large role in determining, what are industry standards going to be, what are best practices going to be when it comes to AI and AI algorithms. But you can be as cynical as you want, and certainly I'm somebody who is sort of that way by nature and by default. But this is a really great move from Epic. I hope that the tool proves to be effective. I hope it proves to be useful, and I hope it's not the last one they put out. The more that they can do to help with the testing and the validation of algorithms within the healthcare space, the better.
Great, thank you. Yeah, it's an unusual move. Epic is seen as, sort of closed source and doesn't play well with others. And so it's unusual to see them put out an open source AI validation tool.
Yeah, no, it's very unexpected. But good for them. I'm glad they did it. The other story that was really surprising to me, but also, very interesting and welcome, was that Tempus is filing for an IPO. Tempus is a real-world data company. They're focused on oncology. They have 2,000 some odd links to healthcare systems and hospitals and clinics and practices, all feeding data into their network and extracting data out. It's, we don't see a lot of IPOs. You're talking about the IPO market being flat, and that is, if anything, an understatement. When we have seen companies IPO, their prices have not prospered. So hopefully Tempus, which is, in an incredibly hot market, feeding AI companies this kind of data, can really show what the results of a successful IPO will look like in the modern age of digital health. This is a company that I think is really well poised, has a lot of growth potential, has a product that is going to be increasingly in demand, and so we'll see. But if anybody is gonna if anybody is gonna have a successful IPO in this kind of market, I would expect it would be a company like Tempus, and I'm excited to see them do it.
Yeah, this is in a great area, and one that has a lot of investor enthusiasm and also a lot of spending by big enterprises, by big pharma on this category. So, we haven't had a digital health IPO in a long time, in over 2 years, and there's many unicorns or former unicorns who would like to go public, but it's not a great time for them to go public. And finally, Tempus is appearing, and it is coming out of the pharma tech world. So the pharma tech is software, data, AI companies that are vendors that build products and services for life science, pharma, med tech, diagnostic, and other kinds of companies. That's pharma tech. Usually they don't require FDA clearance as tools being sold into pharma. And that is an area, pharma is comparatively rich and spendy compared to employers who buy employer health tech, or providers who buy provider tech, or payers who buy payer tech. And pharma can't get enough of and loves right now IT for precision medicine. That is understanding your patient better so you can give them just the right medicine. And also drug discovery, modeling drug targets and modeling drugs a little better, so as to predict that they will have the desired action and they won't have side effects in the body or that sort of thing, before investing millions of dollars in doing it in silico, before investing millions of dollars in doing it in vitro and in the clinic as well. So so really great to see this company filed to go public. I think it's about 7 years old, and many other young companies following its lead. Started in the last few years to do more there. So, and it'd be wonderful for the innovation economy if what we're looking for is for a great company, a high quality digital health company, to go public, and for the stock to go up after it goes public, at least 15%. And then stay up. That's what we really want that to happen. And when that happens, then suddenly you're going to see many digital health companies try to go out as well. And so all eyes on Tempus as it does this. So
Yeah, no, absolutely. There's an interesting question in the chat. Why now for Tempus? Their last raise, their last attributed raise was in 2020. It was a $200 million round. It included Google. And it was their second Series G. They, I think, are at the limits of what their investors are going to keep giving them, even though they are in an incredibly hot, incredibly trendy market. I think now certainly looks like the time. It's been 3.5 years since their last raise. They are due, and I think this is they probably had somebody in their back pocket saying, this is what we need right now. I honestly kind of expected Google or a Google adjacent company to acquire them just for the data and some of the tools, but this makes sense too, and I suspect they'll be successful.
Yes. So, it's a tough time for anyone to go public. We saw a number of companies attempt to go public. We saw J&J's consumer division go public. We saw a hot restaurant chain go public. And a lot of these, we really wanted to see their stock prices go up and stay up. And then you would have seen a big raft of other companies follow them. And instead, there was a very mixed reception, and so things have continued to be slow paced since then. Now with Tempus, they have an AI story powering them. So there's public companies with AI stories where the stock is up high, so that presumes you get a high valuation and strong investor demand. And they're in this hot area, which is pharma companies spending on precision medicine and drug discovery. So those are some positives that told the bankers that they could be successful. But then behind Tempus, there's probably investors saying we need to get out. You need to raise more money from public investors this time. We need to exit in liquidity. That's what's driving the IPO. So.
Yeah. There's a third area too, which is that they're in oncology, which is incredibly hot and has a ton of attention and a ton of interest in it for obvious and totally valid reasons. When we saw a relatively similar company, Alto Neuroscience, go public in February of this year, their stock price plummeted. Alto Neuroscience was in mental health. And as important as mental health is, as important as behavioral health is, it just doesn't have the same kind of funding and oomph behind it that oncology does. So I think Tempus, it's not just the tech, it's not just right place, right time. They're addressing the right kind of cause too, to have some success here, I think.
Great, thanks. And so I'm going to skip a little bit because we need to move on to get to the main part of our show. But I'll just highlight some upcoming conferences. So when I look out there, I see coming up the Health Innovation Congress coming up May 29th to 31st in Washington, D.C. So this is a conference focused on big enterprise buyers of digital health tech and the vendors who sell to them. So it has a focus on employer health tech selling to employer benefit leaders and also provider health tech vendors selling into provider buyers like the hospital CIO. So this is, so if you're one of those vendors selling into those markets, then this would be a good conference to go to, I think. And I got a promo code for our audience for this conference, which is Wardell, my last name, promo code for a 50% discount on tickets for this conference coming up. And then also the Digital Health Innovation Summit in Boston, June 5th to 6th is coming up. This is one of my favorite conferences. This is an investor conference, and it has a great representation of VC investors from Boston and New York and the East Coast and Chicago. Go to this conference. This is the best investor conference on the East Coast. It also nicely falls about 2 quarters after JP Morgan. And so if you've toured the investors at JP Morgan and you want to give an update, this is a good place to go to get an update for this conference. I also have a discount code for my audience there, which is DHIS Social 1524, DHIS Social 1524 for this conference. And I'm going to this conference and look forward to, if you're going, reach out and we can connect at the conference. And then AHIP's coming up. So AHIP is June 13th, 11th to 13th in Las Vegas. And AHIP it's a smallish conference for managers and leaders at health plans get together and talk about the issues, and also vendors go and expo at AHIP and meet with buyers at AHIP. And so I like this conference as well. If you're a vendor that sells into health plans, this is a great conference to go to. This is a conference where you can meet the buyers personally. You're going to sit at a random lunch table. There will be health plan managers there who are thinking about what kind of vendors to buy the product of to put in their health plan. You'll meet them in the hallways. You'll see the same presentations they're watching. And when you go to the expo booths, you'll see all your competitors will be there with 10 by 10 booths. Pitching their story about wellness or care management or consumer-directed benefits or other things like that. Alex, any thoughts on these conferences or any conferences that you go to or recommend in the next couple of months our audience should know about?
Honestly, I don't get out as much as I probably should when it comes to conferences. These are all great. They're all conferences I wish I was going to, and I think they'd be a great choice for anybody.
Thanks. And so our next section is personal notices. We get to just call out things we're doing, chances to meet up, that sort of thing. So for mine, let's see, I'm hosting a walk and talk, a fitness walk for members of the digital health community. So this is coming up Tuesday, May 28th, 6 to 7. we're going to the Boston Esplanade, one of the great walking spots in any city. And we're going to walk from the Hatch Shell to the BU Bridge and back. And then we're going to go out for drinks afterwards. So first we're going to take it off, and then we're going to put it back on. This is Tuesday, May 28th, 6 to 7, the walking part, meeting at the Hatch Shell. And email me if you would like to get to the sign-up page for this. So that's my next. And then I'll also be at the Digital Healthcare Innovation Summit, as I mentioned before, June 5th to 6th. Would love to meet up with audience members who are attending that. Alex, any personal appearances?
I think the personal notice that I'd like to send out is about a man named, if you work in health tech, you work in healthcare, especially in the Boston area, you probably know who John Moore was. John Moore was an incredibly influential figure for me as a mentor, but in the digital health industry across the board. His family is raising money for the charity Bikes Not Bombs. So I would encourage. They're fantastic. I'd encourage you to check them out and consider donating regardless. But in the memory of a man who gave a whole lot to this industry and to everybody in it, I think it's worth spending some time on.
Yeah, thank you. And so those of you out there, if you're in the Boston area, you want to go to the John Moore Remembrance, just email me. I'll send you the details for that. And thanks, Alex, for picking that and bringing that to our audience. And I'll just take a moment to tell 2 John Moore stories. So the first one was he had just started Chillmark, and his prior job is he was a very serious industry analyst covering big enterprise tech for the Fortune, vendors that sell into the Fortune 500. And he had chosen to make his mark with the next step of his career by covering big enterprise tech in healthcare, which is a smaller pond. And so I asked him why he'd chosen healthcare, and he said, because it's the most screwed up. And therefore, the opportunity for an analyst to explain things was greatest in healthcare as compared to anywhere else possible. I think I can continue that thought by saying it's just as screwed up today as it was when John Moore chose to make his mark in the field. So that's the first story, and then the second story it was that 2009. The December, maybe it was December of 2008 to 9 or 9 to 10, I forget. All the work was being done around the High Tech Act and meaningful use, and everybody knew this was going to be big, and that it ultimately wound up involving a $40 billion subsidy being dropped on digital health, a sector that was much smaller than $40 billion at the time, and everyone knew this was going to matter. And then all of a sudden, some raw proposed legislation came out, and it dropped like 2 days before Christmas or something. All of this, so people who work in health tech do not know how to read bills and proposed legislation, printed on legal-looking documents with numbered lines and written in archaic language or whatever. And so this came out, and all of a sudden, all around the world of digital health, and it was even called something different back then. It was called Health 2.0 or Health IT or eHealth or whatever. Our bosses expected us to understand this and tell them what it meant all at the same time. And so one guy actually went and read all this stuff, 200 pages of proposed legislation bill, and then put it into an analytical framework and explained it. And it did this in the days leading up to and including Christmas Day. And that was John Moore. And I remember I knew him a little bit at the time. And I remember telling him, John, nobody does this, John. Nobody does this. But John Moore did. So those are my 2 stories about John Moore. So
when the interoperability rules were coming down and the final rules were getting published, we had a little competition to see who could get it all read first. And it was neck and neck for a while, but I think he won. He set an incredibly high bar. He had high expectations for people, for the industry, but it was just because he wanted things to be better. He knew that he knew what the potential was, and just really grateful to have known him, and really grateful for the impact he had.
Thanks. So now moving on to our main topic, what's working in digital health after an unprecedented wave of software innovation? Where are digital health products creating clinical and financial value for buyers? And this is an optimistic target in the midst of tough times. There was probably over investment in the sector, over entry of new products in the sector. We're dealing with the headaches of that now. We're dealing with a lot of companies have sort of misfired in a certain way. They created a product that didn't address the highest needs of their buyers, or they created a product that was that just in some way they haven't quite found their niche. Their company is still cash flow negative as a result. But we're looking at this survey of what positive developments has software made on healthcare, what is actually working. And so, Alex, let me just give you an open-ended question. What's working in digital health?
The biggest irony of the boom in 2021 is that it was immediately followed by the emergence of Gen AI, which really overshadowed a lot of the solutions and a lot of the tools that had just made hundreds of millions of dollars in investments. Gen AI has managed to create entire new product categories, make existing products better, and that's probably my first answer. The things that Gen AI is best at are taking huge data sets and summarizing them, or taking incredibly huge data sets and making them more usable. And those are both things that are desperately needed in healthcare. When we look at where investment is going, when we look at where attention and effort is going, it's not just a fad that Gen AI is getting a lot of it. These are incredibly flexible, incredibly powerful tools, and we're seeing what they can do, whether it is in, provider documentation, and ambient documentation, which is great, and I hope it saves a lot of people a lot of time. But when we look at the potential in research through biomedical NLP, when we look at what's happening with drug design and the ability to streamline and improve clinical trials, when we look at the ability to create synthetic data sets so that we can have, the breadth and the variety of data that we need without needing to risk people's PHI, those are all phenomenal. And those are going to be significant difference makers in the healthcare industry and in digital health. And they're happening now, which is fantastic to see. Probably the other two areas that I want to call out as particularly effective. First of all, asynchronous telehealth. Asynchronous telehealth works incredibly well. People really like it. I've talked to a couple of vendors over the last 2 weeks who offer both regular video telehealth appointments and asynchronous visits to their clients, and they said, easily 50 to 60% of their visits are asynchronous, and it's only growing. Whether it is because people like the anonymity and not having to talk about, potentially embarrassing or complicated problems, or the convenience, the fact that it's not restricted to times and you don't have to go someplace and you don't have to wait. Whatever it is, people seem to really like it. I am surprised it is not taking a bigger role within healthcare, but as a set of products, I think those are working incredibly well. And then the last set, I think...
Before you go on, can you just give an example of asynchronous drug prescription? And there needs to be a provider and a pharmacy involved, but just so our audience understands that a little better.
Yeah, so an asynchronous telehealth visit is, generally speaking, just a messaging back and forth with a clinical provider. They can provide, all the same interaction, the same questions. Presumably, for most conditions, they need, to have some kind of pictures so that they can diagnose, or some kind of results. But not necessarily. It depends on the problem, and it depends on what they're prescribing for. But as long as the provider is doing a sufficient clinical process, documenting, diagnosing, they can prescribe for a non-controlled medication. And not all asynchronous visits end in a prescription. I think the most effective ones are more about triage and giving people information and helping people understand what their next steps should be. But certainly for a lot of things, it's a lot easier, if you don't have to find an open urgent care on the weekend, or you find somebody who has an open appointment, when your kid throws up. The odds are it's not something emergent. The odds are it's not something super acute, but you want to know that somebody thought about it and looked at it and has given you some good next steps. And asynchronous technology, that just means it's not happening simultaneously, um, is fantastic for that. Just to address a question in the chat, asynchronous visits are not necessarily generative AI. There are some products out there that use chatbots as a part of it. It doesn't have to be anonymous. It can be part of a system that's connected to your medical records, so the provider can review your history. It could be anonymous, although I don't know how they'd prescribe to you if it was. It's just doing all the same stuff you would do in an appointment, during a clinical interview, but doing it through messaging over a period of time instead of doing it face to face in real time. Some of the products out there leverage Gen AI, for doing a form of automated clinical interview. Their results have generally been pretty good. You still have to have a provider review the content of the interview, potentially ask additional clarifying questions, because you'd still need a human to do the diagnosing and any follow-up. But it doesn't have to be. It has enormous potential. It certainly saves providers significant amounts of time, because they can address the questions, when they have a free moment, as opposed to needing to block off an entire period of time. It's a mode of interaction that I think is seriously underused for a lot of healthcare, that does not need the time or the space or the difficulty of finding a face-to-face appointment, whether it's in person or virtual.
So that's great, Alex. And let me just mention there's a couple layers of asynchronous telehealth here. So at one layer, you have a relationship with the doctor, and you've seen that doctor, and the doctor has examined you, and then you have a new question for the doctor. And this could be a legitimate reason to come in and see the doctor for 15 minutes or more. But it also possibly could just be answered immediately and addressed. And that we didn't have. There were institutional reasons why doctors don't do email, for example. The two big ones are emails are not HIPAA compliant, and then also they're not paid to respond to emails. But there's a growing number of different payment relationships, and now through EMRs, HIPAA compliant messaging systems, where you can just message a doctor who you saw a month ago with an additional question, and they can get right back to you. And probably you're not going to be charged for that. And that's just better medicine happening. Now, there's another kind of asynchronous telehealth, which is that I have seen companies where someone wants metformin, which is a cheap over-the-counter drug. It's technically for diabetes, but but in the world of longevity and human performance, it's believed to be a drug that makes you just more have better health, even if you don't have diabetes or pre-diabetes. And someone has gone to a website and filled out a form, and then that counted as being seen by a provider, and then the provider prescribed the medication. The form asked things like, what state are you in? Why do you want this, etc. And then got them a prescription, and they paid for the prescription as well. So in that case, there was no prior relationship with that provider. So you have potentially both of these, but this is turning the act of getting a prescription drug into much more of a simple consumer experience. We go to Amazon, we like pressing one button to order something, and potentially, and we don't talk to someone when we go to Amazon, and potentially your healthcare experience could be like that as well.
Well, it's not a coincidence that Amazon, along with One Medical, deployed Amazon Clinic, which is an asynchronous solution. It can result in a telehealth appointment. It can result in a face-to-face appointment. But most of the time it doesn't. And I think Amazon was smart to recognize the potential of that when it comes to delivering healthcare, but also just purely on volume. The number of people who just need a skin cream or just need something really simple, really straightforward, and it can be prescribed in a clinically responsible way without needing to actually see the person face to face.
And for our audience, now's a good time to ask any remaining questions. And Patricia, thank you for asking so many questions, and we'll get to your next one. So, Alex, I want to ask remote patient monitoring. So if you cycle back, call it 8 years ago, there's no way to get paid for collecting data from when a patient is at home. That made no sense to have a system that worked that way, to have people have to come in and be seen by a skilled person in a clinic in order for that clinician to get paid. So CMS put out some codes, the now famous remote patient monitoring codes, and this has created 2 to 3 waves of startups who are trying to figure out ways to help providers meet the monitoring requirements of the RPM codes, to get the providers then paid for collecting data on patients when they're at home and then using that as part of their care. And so when you look at, and these RPM companies in general, they have not been runaway successes. They will tell you stories that it's hard to get these devices into the home. It's hard to get the data back to the physician and get them paid. And it's hard get patients compliant at home. They might have to get, for example, 16 readings per month. That might require 16 blood pressure cuffs per month, for example. And that the combination of this means that it's clinically valuable to get this data and to use it in care, but it's not. It's hard to set up an operation that works, that makes money to do this. So would you call remote patient monitoring something that's working in digital health? And of course, there's different perspectives. It could be working for a clinician, but not working for an RPM services company, for example.
I think it's working from a purely technical perspective. The technology is out there, people have designed it, and it works. Where it's not working really is from a business perspective. And as with so many things, that is the complicating factor when it comes to healthcare. It was great that CMS put out the RPM codes. They even made some modifications to them in terms of who had to review the data in order to be eligible for payment, and a few other things. Those were good changes, but it's still, really difficult to get the amount of reimbursement that's needed, and particularly to get the level of payment that's needed to make it worthwhile to send a device out that you may never get back. There's a lot of other stuff that needs to happen. You need to have inventory management. You need to have infrastructure in place. You need to be able to get the data off the device. You need to be able to have tools to analyze it. all of those have been barriers. I think probably the area where we're going to see it work best is in the still developing hospital at home, care at home style deployments, where they are not sort of just sending it out into the world, but it's part of a larger surrounding package that includes in-person visits, that includes, people coming in to do some checkups and just to make sure that everything is functioning, and they're being reviewed and monitored, on a different set of criteria than the pure RPM codes that have been established. One of the areas I think that potentially is really impacted by Gen AI is the ability to sort of serve a lot of those back-end integration functions, which can be so complicated. Another one of the things that Gen AI is really great at, taking data and normalizing it, building unified data sets off of, data coming in from different devices from different manufacturers, even if they're all, nominally within the same or similar formats, it still can be difficult and complicated to pull all of that data together and make sure that, it's all analyzable and it's all readable. Gen AI is already making a difference with that, and I think is going to be able to make it a lot more reasonable, where you don't have to have every product, a full set of products, a full set of services, infrastructure, all coming from the same vendor. You'd be able to find the things that work best for you, that are right for your patients, and then make it a lot easier to tie them all together. It's hard to picture a future of healthcare that does not involve RPM in some way. It's too useful. It opens up too many possibilities. It may be that, it stays in the realm of, companies that are moving out of the insurer fee-for-service, even fee-for-value space, that are, whether it's paid by an employer, it's paid by a payer, or it's paid by the patient, have some kind of per member fee or subscription, direct primary care, concierge care, whatever you want to call it, because, it can make a difference for them. I don't think it's, when we look at Amazon, for example, with One Medical, the ability to consistently and reliably keep chronic patients and polychronic patients under control of whatever their condition is probably the biggest determining factor when it comes to the total cost of care. And so anything that lets you do that is probably worth doing if you are in that kind of financial relationship, which One Medical is. I don't think it's a coincidence that we're seeing Amazon pay more attention to that and start to partner with companies that provide remote monitoring and care management tools. It wouldn't surprise me to see some acquisitions come in that space for exactly those reasons. And for other companies that are competing in that space, I think we see similar demand. It may be that outside of a few specialized circumstances, we don't see fee-for-service and even fee-for-value vendors or providers involved in the RPM space, and I think that'll be too bad. That's certainly not the best outcome for patients, but I don't think there's any question that RPM as a technology is working in healthcare, and there are companies and people finding ways to make it work financially.
Yeah, thank you. Yeah, and I would mention with remote patient monitoring, at the most basic level, you're getting data about the patient and the patient's condition, not just when they're in a clinic, and they might be off when they're visiting the clinic. You're getting, with the clinic, you're just getting snapshots. Someone who's blood pressure is being measured may be feeling very stressed when they go into a clinic to get their blood pressure measured, for example. And you want to get a fuller picture. You want to get multiple snapshots per month of people's data. So just for that reason alone, it's a big win, and the fact the government's paying extra for this is great. But it also addresses issues like if you're in a hospital, you may want to be discharged, and the hospital may feel like they have to keep you to monitor you, but now they can send you home, and you can use the monitoring equipment from home, and so you have a higher quality of life for the patient, and the hospital gets better data. It's a win all around.
Yeah.
So moving on to a different topic, decentralized clinical trials. So if you cycle back before the pandemic, clinical trials were run in an incredibly conservative way. The pharma companies had a great fear of the FDA and that any kind of novelty would be suspect by the FDA. And so when it came to running a new clinical trial, they did it. They're expensive and difficult enough as it is, let alone trying to introduce novelty to them. And so they just ran them the way that the last successful clinical trial was run in that field. And that meant that that clinical trials were run out of sites, and patients had to come into the site. So that limited your population of patients to just people who lived near sites, for example. And then patients had to come in to the site for monitoring and for medications, collecting for and with the pandemic, those sites became problems. And pharma did a crash course of investing in what became known as the category of decentralized clinical trials. And so this allowed patients to take the monitoring devices home with them. And so now patients would take the monitoring equipment and the interviews and the drugs home with them. And this then allowed for different equipment and software to be used and different trial protocols to be done. And so the ultimate goal of all of this was to reduce the time it takes to run a clinical trial, which can take a large amount of, it can take a long time and suffer delays because of problems with getting the right number of patients and keeping those patients going in the trial. And so decentralized technology and those delays, they mean the life-saving drugs don't get to market, and they also cost huge amounts per day of delay on the patent-protected time of a pharma company, where they can charge a high price. They want that extra 6 months or that extra year of being able to charge a high price on that drug before the patent expires. So would you call this big investment by pharma over the pandemic in decentralized clinical trials a win? Is this a thriving, great sector that's lived up to its promise, or is it not? Or is it not working?
I think we're waiting for it to finish playing out. I don't think there's any question that decentralized clinical trials in the abstract are immensely valuable. Alongside everything else you discussed, and all of those are totally accurate. It's opened up access to clinical trials to people who never had it before, people who are just don't live near trial sites, don't live near academic medical centers, weren't able to access, these kinds of trials and access to these kinds of novel treatments. It's enabled significant increases in the diversity of trial populations, economically, demographically. We have learned over the course of the last, 5+ years, as we've gotten better and better at analyzing healthcare data, at clinical trials, and the data that we have been relying on to show the efficacy and the dosages and the frequency of medications has been incredibly flawed. That it's been really lacking when it comes to people of different backgrounds, people of different physical composition, different genders, and the ability to conduct a decentralized clinical trial has meant that it's much easier to get the kinds of data and recruit the variety of people needed to really have a clinical trial that is as robust as it ought to be. That said, it's all a numbers game and it's all a money game. And the clinical trial process is so extended and so long that I don't think we've seen, the final conclusion of whether or not it's paying off. I suspect that it is, based on what we see in investments, based on what we see in activity, the numbers that we see. There is more money pouring into it. It's one of the faster developing sectors within clinical trial tools. We see, a lot of companies that are, I hate to get back to it, but leveraging generative AI, to make it easier to contact patients, to make it easier to keep in touch with patients, to make it easier to collect information on them, to make it easier to recruit them. We're seeing a lot of progress in tools to integrate into the EHR and make it easier for doctors to see what clinical trials their patients might be eligible for and enroll them in it, and get that process begun. So I do think that this is a technology that is, finding success, that has found acceptance. I think pharma companies, by and large, seem to be a lot more willing to face reality and take on, novel tech and new changes when they have to. I hope it stays, and I suspect it will, but I think we won't really be able to make that judgment for another couple of years. And there's a larger set of decentralized clinical trials that have run through multiple stages and been able to show cost savings and efficacy.
Great, thank you. And so now we're going to try to address a couple of questions from audience members, and then conclude. So Stephen in the audience asks, why the slow uptake on RPM overall to date? So good question, Stephen. I'll try to provide a little bit of perspective on that. So first, an example of an RPM code might be that if you can collect 16 blood pressure readings per month, and then the provider receives that data and once a month checks in on it and utilizes it, takes it into consideration along with all the other data, makes a knowledgeable assessment of the patient's current diagnosis and care plan, and uses that to inform a possible change or improvement in that diagnosis and care plan, and then talks with the patient also during that month, then you can bill $109 per patient if you do that. So that's an example of an RPM code. So the first problem there is that this actually creates a labor problem for providers. So providers have a fixed number of staff. It's very hard for them to expand staff or get flexible staff. And now they have to have people who do this. And for a hospital, this might be hiring several people or more to take this on. They may not want that labor challenge. So now they have to rely on a third-party organization, which is a RPM services company, to hire. It's going to have several hospitals as customers to hire a greater number of staff and spread the load of this kind of work across that staff. So that's an obstacle to rapid uptake of RPM. A second issue with this is that you don't control the patient, and with putting on and taking off a blood pressure cuff on 16 separate days over a 30-day period, you may invest, provide the device, provide the labor of a clinician, do all this work, and then find out that your patient said they would do it and didn't do it, and now you can't charge for it. So there's risk. And then the burden actually falls on you or the service provider firm to go and next month, reclaim the device or get them to take the 16 readings. And lastly, on a disease-specific basis, this can be profitable or it can be unprofitable. So if you're going to get, if you have very sick cardio patients, you get the same $109 as if you have, diabetic patients who don't feel particularly sick, for example. But with those very sick cardio patients, you need to react immediately if you get seriously negative data. So a particularly acute case, you're going to see people not seek the RPM fees because they would have to be monitoring, watching that data like a hawk. They're not going to be able to set up that kind of response center for those low kind of fees for this. So that's been, I think it was great that there were certain people at CMS who got these codes created and pushed through. That was it's hard to do. That's great. But a simple way of putting it is that the money's not that great for the amount of work you have to do. And in certain cases with acutely sick patients, it's not worth it at all to set up the kind of response center you would need to set up. So that's my take on why uptake has been slow. Now, uptake by entrepreneurs, many entrepreneurs reacted like lightning to go and build businesses around these codes. But then providers did not act like lightning, and then a lot of these decisions were made when you didn't know what the final infrastructure it would take would look like. And then when you look at that infrastructure today to get to the 16 readings and to get payment, it is it has not been strongly profitable for those who pursued this. So, Alex, any further thoughts?
Yeah, I think the other thing to keep in mind is that we're still seeing a lot of this develop. RPM technology a few years ago was significantly clumsier than it is now. The work we've seen done in miniaturization, the work we've seen done in terms of deploying edge and fog AI technology to make them a lot more effective has been pretty remarkable. We've seen a lot of progress in terms of finding visual biomarkers, motion biomarkers, vocal biomarkers that can provide insight into patients without needing even a wearable at all. And so all of that has needed to progress. When it was you had to strap on a big device and wear it on your arm, yeah, it was going to be a hard sell for a lot of people. Once it became smartwatches and rings and things like that, you started to see more interest. And I think we'll see that continue in different situations as the technology continues to evolve. The other thing is the software background, as you were talking about. The ideal for this, the sort of best use case of RPM technology is that you are able to analyze and track that cardio patient's vital signs and recognize the very beginnings of a downturn without them ever getting to that really critical stage where it's obvious. That requires a lot of software time. That requires a lot of analysis. That requires a lot of training of algorithms. And we are getting to the point where that is cost effective, that's relatively easy to do. They can be, accurate, but they're still not as accurate as we'd like them to be. And that software is going to continue to develop. So I think it's worth recognizing that, we're at the very early stages of a lot of this technology. And the fact that healthcare always takes longer than other industries also needs to be taken into account. A lot of doctors don't know that there are remote monitoring reimbursement codes for their Medicare patients. More of them don't know that there's remote therapeutic monitoring codes. Many of them, even if they know that the codes exist, don't know what the requirements are, don't know who has to do the activity, don't really know how to bill for it. All of that needs to, become part of the mainstream knowledge set before people are going to really adopt these tools. We're getting there. It's slow. It's taking time, but I think that's a big chunk of it, certainly.
And so why don't we wind up here? And I'll just say in summary, we didn't touch on what I'm about to say before, so I just wanted to bring it up. I do think that there was a lot of resistance to digital health in the past by the healthcare system. And interestingly, the pandemic caused a massive movement to telehealth, to call it video visit between the physician and the patient, telehealth. The pandemic caused patients who were slow to change to get ready to do visits virtually on their phone. It caused providers, doctors, nurses, and others who did not want to change, didn't want to get set up in their office to do video calls, which might have involved a webcam and different software, for example. Providers changed, and then also the provider enterprises and payers and government changed to facilitate this. And now it's trivial to think that you might, have a condition, go see your doctor in person, and then they say our next visit will be a telehealth visit inside the EMR, and maybe it's a Zoom client that's HIPAA compliant inside the EMR, or you're using Apple's video system, and so that I think that's a big win of what is working. That your visit number 2 doesn't have to be, you don't have to drive, park, pay for parking, walk into a waiting room, wait, fill out paper forms in the waiting room, and then be taken into an exam room, wait again in the exam room, and finally see your doctor for 5 minutes every time you want to visit. So now at the same time, there's been a lot of press about how these video visits and the vendors behind them are being commoditized, and that we're seeing distress from Teladoc and other video visit providers because that particular part has been commoditized. So that's a line of business that had some boom years and is being commoditized, but I'd say it's working because the different actors, all of whom could have resisted this change, wound up embracing it. And so today we don't think anything of video visits. But with that, Alex, any concluding thoughts on what's working in digital health?
I just want to add one thing to that thought about video visits and telehealth. We do all take it for granted now. The regulatory exceptions and the things that had to be waived or had to be put to the side in order to enable all of that are still there. We have not reached a point where those have been made permanent. And so it is still possible for the regulatory side of this to pull everything back. It's worth keeping that in mind also. Telehealth visits are working great. Absolutely. They've become part of standard practice, but it's not hard to envision a world where 6 months from now they haven't been renewed, the exceptions haven't been renewed, and all of a sudden we're back where we were in January of 2020.
Yeah, just touching on that briefly, during a pandemic, many rules were waived. And to pick 2 examples of this, there are cases where visits are traditionally done in person, and you could substitute a telehealth visit for that. Another example would be cases where the patient and the provider are expected to be in state, and the provider, of course, is licensed in state, but you then allow either a Massachusetts licensed provider who's anywhere to practice, or the Massachusetts resident who's anywhere to be seen. But then you could also further waive that and say that in an emergency, a Texas provider could do a telehealth visit with a Massachusetts resident, and you're just waiving state licensures there. Well, it turns out that the actors behind state licensures didn't go away, and they still care. And so in many states, the state medical board is one of the most influential and also most highest donation lobby groups in the state. And they have no sense of humor, and they do not like to see business go to, from, if they're paying their dues in their state and they're paying for practices on Main Street in their towns in that state, they don't like to think that someone, with a different licensure or in a different state can just practice medicine in their state. And so they are pushing, you're sort of thinking, what's going on here? Why is there this blast from the past of regulations restricting telehealth? Why are they threatening to come back? And the answer is that someone's ox is being gored, and they're very interested in bringing back the old rules to support the old way things were done. And so You're right. Some of these waivers may go away because the pandemic's been over for a few years now, and then we may see old restrictive rules come back. So great. Well, thank you so much, Alex, for coming on the show, and it was really great to get to know you better and hear your perspective.
Well, thank you so much for having me. This was great.
So you've been listening to Digital Health Investor Talk with host Stephen Wardell, and special thanks to our guest, Alex Lennox-Miller of CB Insights. We'll be publishing this show as an episode of the Digital Health Investor Talk podcast. Subscribe on Apple and Spotify, and don't forget to rate us. Our next show is Tuesday, June 4th, where we talk about the return of the solution aggregators. And this is our guest, Michael Pace from Palm Health Co. And this is one of our favorite topics of our audience as we look into solution aggregators like Virgin Pulse and Accolade and others, and how they're serving the employer market. And for our Boston audience, don't forget our Walk and Talk Fitness Walk on the Esplanade on coming up on May 28th. And that's it. Thank you, and see you again next time. Bye-bye.